For generations, we've been told a story. A simple story. That the single best way to build wealth is to own a home. It's been treated as an undeniable truth, a financial gospel so foundational that to even question it seems, well, foolish. Today, we're going to be foolish. We're taking a scalpel to this sacred cow of personal finance to dissect, layer by layer, the mathematical myth of homeownership. This isn't about the feeling of a white picket fence. This isn't about the American dream. This is about the cold, hard numbers.
You know this phrase, you've heard it from your parents, your friends, from every real estate agent and mortgage broker you've ever met. It's the cornerstone of the entire myth. It's designed to create a sense of panic, a feeling that every dollar you pay in rent vanishes into a black hole. But what if it isn't true? What if this simple, catchy phrase is actually the most effective, most damaging lie ever told in personal finance? Today, we put that lie on trial.
And this is how they do it. They use language that triggers a deep sense of loss. You're just throwing money away. You might as well be setting a pile of cash on fire every month. The implication is crystal clear, isn't it? That every dollar you pay for rent is a complete, irreversible loss, while every dollar that goes toward a mortgage is a wise, wealth-building investment. We're here to challenge that very premise.
Now here's the slightly more sophisticated version of the argument. It's a clever bit of psychological framing. It paints this picture of a villain, your landlord, getting rich off your back, and a victim, you, the renter, unwittingly funding their retirement in Florida. It's a powerful emotional lever designed to make you feel like a pawn in someone else's game, to push you out of the victim column and into the owner column, no matter what the cost.
And of course, it's all wrapped up in this beautiful, almost unassailable cultural narrative, the American dream, the pride of ownership, the idea that putting down roots and owning a piece of land is the very bedrock of a successful life. It's been sold to us not just as a financial move, but as a moral one, a patriotic one. But today, we're going to strip away the narrative, peel back the emotion, and confront the cold, hard reality of the data.
So here's our protocol for this analysis. First, we're going to expose the industrial-grade marketing machine behind this myth. Then, we'll put real estate into the ring against the stock market using 3 decades of hard data. We're going to introduce you to a critical mental model for calculating the true hidden costs of ownership. After that, we'll explore the deep-seated psychological biases that make us so vulnerable to this myth. And finally, we will give you a clear, data-driven protocol to make the right call for yourself.
Let's be perfectly clear about something. The belief in homeownership as the superior investment doesn't persist because the math supports it. It persists because of a decades-long, multi-billion-dollar marketing effort from the conjoined twins of the real estate and banking industries. They have masterfully framed the act of taking on massive debt to buy an illiquid asset that needs constant cash infusions as the safe and smart choice. Meanwhile, investing in a diversified portfolio of the world's most profitable companies is often labeled as risky gambling. It's an incredible inversion of reality.
So, to dismantle this lie, we have to start with a clean baseline comparison. We're going to strip away all the emotion and just look at the raw performance data. Let's imagine it's 1992. You've got a chunk of money to invest for the long haul. You have 2 main choices: the U.S. stock market, which we'll represent with the S&P 500, or the U.S. housing market. We're going to track these 2 assets head-to-head for over 30 years, through booms, bubbles, and devastating crashes, to see which one actually came out on top.
And the results, well, they're not even close. From 1992 all the way to 2024, the S&P 500, with all dividends reinvested, delivered an average annual return of 10.39%. Thanks to the magic of compounding, that is enough to double your money about every 7 years. Now look at housing. Over that exact same period, U.S. housing appreciated at an average of just 5.5% a year. I want you to let that sink in for a second. The stock market's returns were nearly double that of real estate. If your primary goal is growing your capital, the historical data could not be any clearer.
You don't need a degree in finance to understand this visual. The difference in performance isn't a rounding error, it's a chasm. Over a 30-year career, that gap between the green bar and the yellow bar represents hundreds of thousands, sometimes millions of dollars in wealth that you could have built but didn't. These 2 bars represent 2 completely different financial destinies.
But wait, it actually gets worse. That 5.5% return for housing, that's the nominal return. It completely ignores the silent wealth destroyer, inflation. You've heard people brag, right? I bought my house for $200,000 20 years ago and I just sold it for $400,000. They think they're a financial genius. They're not. They're just forgetting that the dollar itself lost a massive amount of its purchasing power over those 2 decades. When you adjust for inflation, the real return on national home prices is barely 1%. 1. As Nobel laureate Robert Shiller proved, over the very long term, housing is little more than a store of value. It basically just keeps pace with inflation. It doesn't meaningfully create new wealth.
And to really understand the risk you're taking on, we have to revisit the 2008 financial crisis. This wasn't some freak accident. It was the predictable result of applying massive leverage to an illiquid asset that everyone believed was safe. In 2005, the mantra was real estate never goes down, and that fueled a speculative bubble. By 2007, the first cracks appeared. Subprime borrowers started to default. Then in 2008, the entire bottom fell out. By 2009, millions of American homeowners were trapped, their life savings evaporated, owing far, far more than their homes were actually worth.
Let's make this brutally personal. Let's put you in the shoes of a homeowner in a hard-hit market like Las Vegas. The year's 2006. You buy a house for $400,000. You put 5% down, that's your entire life savings, $20,000. You feel great. You're an owner. You've escaped the trap of dead money. Then, the market turns. By 2009, that same house is worth only $200,000, but your mortgage is still for $380,000. Your $20,000 in equity? It didn't just go to zero, it's been completely vaporized. You are now underwater by $180,000. You've lost 100% of your investment, plus you're trapped in a debt nearly twice the value of the asset. You can't sell, you can't move for a better job, you are chained to a sinking ship. That is the devastating power of leverage when it works against you.
But a catastrophic crash is only one part of the risk. Even in a perfectly stable, boring market, homeowners face a slow, silent bleed of wealth. It happens through hidden, unrecoverable costs that are almost never talked about in the sales pitch. And here's the kicker. These costs function exactly like rent. It's money you spend for the privilege of living in the property that you will never, ever see again. So how do we quantify this financial bleed? Analysts use a powerful mental model called the 5% rule. It's a simple framework for estimating the true, all-in carrying cost of a residential property. And the rule is simple. Every single year, you can expect your unrecoverable costs, your owner's rent, to total about 5% of your home's value. This is money that, just like your renter friend's check, is gone forever. So what's in this 5%? Well, the biggest piece is the cost of capital. If you have a mortgage, this is mostly the interest you're paying to the bank. That's not building your equity. It's the bank's profit. If you paid cash, it's the opportunity cost, the money you could have made if you'd invested that cash in the stock market instead. Next up, property taxes. Think of this as the rent you pay to the government for the land your house sits on. And finally, the silent killer, maintenance and repairs. Roofs fail, water heaters break, foundations crack. These aren't investments. They are constantly depreciating assets that require huge cash infusions just to maintain the status quo.
Okay, let's put the 5% rule into action with a real-world comparison. Let's take $1 million property. Using our rule, the owner's unrecoverable costs are about $50,000 a year. That breaks down to roughly $4,167 every single month. Now let's say the market rent for a comparable property is $3,500 a month. Now look at the verdict. In this very common scenario, the owner is losing $667 times more in dead money each month than the renter is. On top of that, the owner is shouldering all the risk, all the liability, and all the illiquidity of the asset. Suddenly, renting doesn't seem so dumb, does it?
So this brings us to the big question. If the math is this clear, why do so many of us consistently make the wrong choice? The answer isn't in our spreadsheets, it's hardwired into our DNA. For hundreds of thousands of years, our survival depended on securing physical territory. We are descended from the ancestors who found the safest cave, not the ones who had the best performing portfolio of abstract assets. Our brains are simply running on ancient software in a modern financial world. This is a well-documented cognitive bias called tangible asset bias. Our brains evolved to value things we can see and touch. A house feels solid, permanent, real. You can stand on your lawn and feel secure. In stark contrast, your stock portfolio is just a bunch of numbers on a screen. It feels abstract, unreal, and therefore risky. Our caveman brain instinctively confuses the physical permanence of a house with financial stability, even when all the data points in the opposite direction.
So how do we fight back against this? How do we overcome these deep-seated biases and make a truly rational decision? We need a system. We need a protocol that forces us to ignore the cultural story, the emotional pull, and the industry sales pitch. We need a framework that focuses only on the mathematics of our specific situation, in our specific market, at this specific point in time.
Here is that protocol. It's 3 simple steps. First, you calculate the price-to-rent ratio. You take the sale price of a property and divide it by the total annual rent of a comparable property. A ratio above 20 is a major red flag that the market is likely overvalued and renting is probably the better deal. Second, you run the 5% rule on the property you're considering. Be brutally honest about the costs of interest, taxes, and maintenance, and compare that monthly dead money figure directly to the cost of rent. And third, and this is the most critical non-negotiable step, if renting is cheaper, you must automate the investment of that monthly savings into a diversified portfolio like a low-cost S&P 500 index fund. This is how you actually capture the financial advantage.
This really requires a complete paradigm shift in how we think. We have to stop using the language of the people trying to sell us something. Rent isn't a failure. It's not dead money. Rent is a calculated fee you pay for an incredible bundle of benefits. It is the price of flexibility, the freedom to move for a new job without friction. It's the price of liquidity, keeping your capital ready to deploy in higher returning assets. And it is the price of freedom from the enormous risks, headaches, and hidden costs of owning and maintaining a physical structure.
So I'll leave you with this one final question. And I want you to be brutally honest with yourself. Look at what you call your largest asset. Is it truly an asset, a vehicle that is propelling you toward financial freedom? Or has it become an anchor, weighing you down with debt, illiquidity, and 1,000 hidden costs, pinning you to one spot while the world of opportunity moves on without you? The math doesn't lie. The choice is yours.